Hello, everybody. We're going to get going here in about another minute. I'm going to shift this over. So if you guys remember, I'll have the chat kind of over here to my right. So if you ever have any, questions, I'll try to have the chat over here where I can see it. Obviously, you can unmute yourself and ask a question as well. Today, there's actually a lot more questions, so I'm going to try to move quickly through them as best I can. But obviously, I still want you to be able to ask questions and things like that. So we only have another minute here, but I'm going to go ahead and start sharing my screen to make this a lot more efficient. Okay. Just moving some stuff around here. Okay, everybody. All right, so if you hadn't guessed already, Chapter 16 definitely has a lot more details and a lot more just nuance to pay attention to. And so hopefully this extra practice helps kind of reinforce a lot of the things you've already been studying. So we're just going to jump right in. So 49er Company grants CEO stock options on January 1st, 2021. The total fair value of the stock options is $175,000. The stock options cliff vest after 4 years. So on June 30th, 2023, the CEO leaves the company. And so we need to provide the journal entry information for June 30th, 2023. So whenever you see somebody leave, whether it's CEO, employee, whatever it might be, whenever you see someone exit a company, the number one question whenever you're talking about the calculation is how much compensation expense already accrued. So you have to think how much accrued before this person left. Now, this is in the middle of the year. So you got to remember that the compensation expense is adjusted at the end of each year. And so the last time that there would have been an adjustment or some sort of recording of compensation expense would have been at the end of 2022. And so it's really important that you keep in mind that this is not a monthly adjustment. This is an end of year adjustment for the purpose of this class. And so we've got to think about, okay, so given that it happened at the end of December 2022, that was the last time there was an adjustment. And so essentially we have to think, okay, what would have been those journal entry amounts if I could get the right color? The total compensation expense was 175,000. It's a 4-year investment period. They would have made an accrual adjusting entry at the end of 2021 and at the end of 2022. So they would have previously recorded 2 years of compensation expense for a total of 87,500. And since that was the total that had been accrued whenever the CEO leaves, that's the journal entry amount. And so we know the journal entry amount is going to be 87,500. So that's one part of it. And so the other piece of it then is the accounts. And so whenever an employee leaves, whether it be in this situation or with restricted stock, you're trying to unwind, right? So you're trying to kind of undo the previous entry. So we know that there would have been a debit to compensation expense at the end of each year, and also a credit to paid in capital stock options at the end of each year. So and that would have been a credit. So you have that debit and credit happening at the end of each year. And so when they leave, we need to unwind it. So we need to flip that. And so the journal entry then would be we would be debiting the paid in capital stock option account, and we would be crediting the compensation expense to unwind that. Does that make sense?
I got a question.
Sure.
It started in January of 21 and ended in June. Isn't that 2.5 years?
So again, we have to imagine what entries have been made. And while it is 2.5 years, they would not have made any journal entries between January 1st, 2023 and June 30th, 2023. The only two journal entries related to this compensation expense that would have been recorded would have been on December 31st, 2021 and December 31st, 2022. So when the CEO leaves, we don't have to undo anything from 2023 because we haven't recorded anything. Good question, though. Any other questions? Okay. All right, let's move on to the next one. On June 1st, 2021, a firm issues 20 bonds, each with a face value of $1,000. The firm raises $20,400 from the issuance. Each bond includes 2 detachable warrants to purchase common stock at $12 per share, and those warrants have an expiration date of December 31st, 2025. An investment bank estimates that the fair value of the bond is 99.5% of the face value, and each warrant has a fair value of $11. So we need to provide the journal entry for this issuance on January 1st, 2021. So there are really two methods. One is the incremental method, and the other is the proportional method, or the residual method, sometimes I guess would be the other one. And it really just depends. Can you reliably estimate both pieces of the security, or can you only reliably estimate one? And in this case, we have estimates for both the bond and the stock warrants. And so, since we have a reliable estimate for both pieces of the security, we need to use the proportional method. If we had only been able to reliably estimate one, then we'd use the incremental or the residual method. All right. So, with the proportional method, there are two steps to the proportional method. The first step is to figure out what the fair value of each item is. And then the second step is to proportionally allocate the issuance or the issue amount. And so we know that ultimately we're allocating 20,400. So in this two-step process, that is what we're trying to do. The company raised capital, and so we're trying to figure out how to allocate that. And so with that first, if I can get it correct here, yeah, right there. So we do know that ultimately the company is receiving $20,400 cash, and we're just trying to figure out how we should allocate that. And so again, the first step is to calculate the fair value of each item that's part of this packaged security. And so with the bonds, the fair value is 19,900. Again, the way that we know that is that we have 20 bonds, each has $1,000 face value, which gets us to the 20,000. And at the same time, we know that the fair value of each bond is 99.5%. So we take the total face amount of the bonds, multiply it by the 99.5%, and we know that the estimated fair value of the bonds is 19,900. So for the stock warrants, we know that there are 20 bonds that are part of this issuance. Each bond has 2 stock warrants, and we are told that the fair value of each warrant is $11. So the total fair value of the stock warrants is $440. So that tells us that the total fair value of those items combined is 20,340. Now, if these two estimates had perfectly captured this issuance, then the cash that we would have raised would have been exactly $20,340. But you can see that it was not. The cash that we raised was more. And what that tells us is that the bond and the stock warrants, these estimates, while good, weren't exactly perfect for this transaction. And so then that second step basically makes a correction for that. And so, oops, if I could do this correctly. And so now the second step is to proportionally allocate. And so we take that 20,400 and then we allocate to the bonds the proportion of the fair value that is represented by the bonds. So 19,900 over the total gets us 19,959 allocated to the bonds. We take a similar approach for the stock warrants, and we can see that we allocate $441 to the stock warrants. So you can see that both amounts were incorrect, and this proportional method just kind of gives us the adjustment that we need. And so, of course, the bonds then, since the face amount is 20,000, we know that the bonds were issued at a discount. And so we have to take that into account. And so when we do our journal entry, it's really two parts for the bonds. The face amount is what we assign to the bonds payable account. We learned that from Chapter 14. And then because the allocated amount to the bonds is less than the face amount, the difference then is the discount balance. And the second piece is just the paid in capital stock warrant, and that's allocated the fair value of 441, or the proportional fair value of 441. So for these types of problems, this is kind of as complicated as it gets for those stock warrants. Any questions on that one? Again, I'm trying to move a little more quickly just because we have so many problems to get through. And I'd prefer that we get a view of all the problems rather than going really slowly through each one.
Can you explain the 41 discount, how it's less than the bond fair value again? Or
Sure. So the bond fair value is not really the relevant as far as the measure of the discount. This bond fair value isn't really the most important number. It's the allocated amount to the bond that's most important. And so we've allocated to the bonds $19,959. The face value of the bonds we know is 20 bonds, $1,000 each, for a total of 20,000. So we know that for purposes of the journal entry, we need to assign $20,000 to the bonds payable account. Because we have allocated an amount that is less than that par value, the difference then, because it's less, needs to be assigned to the discount balance. If the amount that had been allocated would have been more than 20,000, then any amount over the par value would have been allocated to the premium account. Does that make sense?
yes, that makes sense. Thank you.
Uh-huh, no problem. Any other questions? Okay. 49er Company has issued each of its 10 executives 215 stock options. Each option has a fair value of $9.50 and an exercise price of $23 and are already fully vested. So we kind of have to think about where we are in time. So they've been fully vested. 4 executives exercised their options on January 1st, 2021, when the market price of the stock was $27 per share. We're going to assume that there's no par value for this common stock. And so we need to provide the January 1st, 2021 journal entry. So one thing I just want to highlight here is with each of these problems, I am going to how did I, sorry, one second. I'm going to give you more information than you actually need in most cases. And so I just want you to kind of understand this. You're going to have more information than you need on a lot of these problems. So on this one, obviously the important things when they exercise the options is the exercise price, because that's the price they have to pay the company, the fair value, because that's the amount that we had signed to the paid in capital account, and the number of executives that exercise it, which is 4 in this case. And so we need to kind of walk ourselves through these calculations. And so we're going to kind of start with the first one, which is the amount of cash, which is the amount of cash that the employees had to pay in order to exercise these options. And so we know that each employee has 215 options that's given here in this first line. And we know that 4 employees exercise all of their options, which means in total, whatever 215 times 4 is, that's the total number of options that have been exercised. The price to exercise the option is $23. And so, of course, we just multiply through, which means that for these employees to exercise their options, they would have had to pay the company $19,780. And so that's the first part of the journal entry. All right. So the company is going to receive from their employees $19,780. The next piece is, let me kind of highlight, I think that's where I need to stop. Yeah. So the next piece is that paid in capital, and I need to go a little further. I think it's right in there. We'll see. All right. That's not bad. The paid in capital stock option account. And so if you recall, at the end of each fiscal year, we debit compensation expense and we credit proportionally the paid in capital stock option account. And they would have been doing that over year over year over year over year. Of course, we're past the vestment period. So that paid-in capital stock option account has reached its maximum account balance. So it's just kind of sitting there until the employees start exercising their options. And then as soon as they start exercising the options, that paid-in capital stock option account needs to be reduced for the amount of the options that were exercised. So again, it has a credit balance. And as the employees exercise those options, we would be debiting that account, of course, proportionally to the number of options that have been exercised. And so again, the fair value of each option was $9.50, and so that's the most relevant information for this part of the journal entry. And so again, you have 4 employees. Each of them exercises their 215 stock options, and these stock options had been assigned a value of $9.50 per option. And so as soon as those options are exercised, we reduce the paid-in capital stock option account by $8,170. And so that's the second debit that we have, $8,170. And so then the last journal entry is fairly straightforward. And the reason why is because there is no par value on the common stock. And so, of course, whenever they exercise those options, we are going to be issuing stock in order to fulfill those options. And so in this case, because there's no par value, the entire issuance amount goes into the common stock account. And again, the two components to the issuance is the cash and the paid-in capital stock option amount. Those two amounts together give us the value that should be assigned to common stock. And so someone asked, so why don't we use the $27 per share? And the reason why is because for US GAAP, and I believe it's the same for IFRS, the market price the day that the stock options are exercised is actually irrelevant, because our contract is with the employee. And so the employee says, hey, I give you $23 and you give me a share of stock. That's the option that he has. And so that's the transaction that's relevant to us. And so what the employee does with the share once it's been issued to them, it's completely their call. Now, obviously, probably they're exercising this option in order to go out into the market and then sell it for $27, but that's not really relevant to us because that's a secondary market transaction. So the $27 is extra information that is not needed for this problem. Any other questions? Okay. On January 1st, 2020, 49 Company grants each of its 10 executives 65 stock options. The options cliff vest on December 31st, 2024. So quick math says that's 5 years. And they have an exercise price of $12 per share. At the time the options are issued, 49ers stock price was $18 per share, and each option had an estimated fair value of $4.25. Provide the journal entry if 6 executives leave the company on June 30th, 2021. All right, June 30th, 2021. All right, so again, whenever employees leave, we always have to ask ourselves, how much has accrued prior to the executives leaving? And so if they leave on June 30th, 2021, the only journal entry that we would have had would have been the December 31st, 2020 journal entry. So how much has accrued? The answer is only 1/5. And so then we're going to go through and kind of show the calculation here. Oops. And so the entry amount hopefully is fairly straightforward. We have 6 executives that leave. Each of the 6 executives were granted 65 stock options, and the fair value of those stock options was $4.25. And so what that tells us is over the 5-year period, in total, we would have accrued whatever that amount is, 6 times 65 times $4.25. But we only do 1/5 of it every year because it's a 5-year cliff vesting arrangement. And so as of this date, this January 1st, 2020, that's the value that eventually would have been recorded. But whenever the employees leave, we would have only recorded 1/5 up to that point. And so the amount that had been accrued would have been $332 for these employees. And similar to the problem that we had done above, we just unwind the previous journal entries. So we take the compensation expense. I flipped those. I need to fix that. we go. Again, we're unwinding the previous journal entry. So we're taking the paid-in capital stock option off of our books. We're taking the previously recorded compensation expense off of our books as well, in order to make the adjustment for when those executives leave. This is very similar to the first problem, but the first problem was just one CEO. If you notice, the accounts are the same. The way we calculate it is the same. This one's just a little more involved because you have to kind of do a little math. You got to figure out the number of executives, the options per executive, and the fair value per executive. So this one's just a slightly more difficult version of the one we had already done. Any questions on this one? Okay. All right. 49er Company issues $100,000 in 20-year, 5% annual bonds at par on January 1st, 2021. Each bond has a par value of $1,000, so there's 100 bonds. Each bond has a conversion option where it can be converted into 20 shares of common stock. 25 bonds are converted on December 31st, 2021. At this time, the market price for 49er stock was $25 per share. Provide the journal entry for December 31st, 2021, when these bonds are converted. So again, with the conversion, we're doing is we're taking the bonds off of the books and we're issuing stock in their place. And so the calculation hopefully isn't too bad. The first part of it is taking the bonds off of the books. Now, since these are issued at par, it's a fairly straightforward journal entry. The bonds payable account, of course, there's 25 bonds. Each bond has $1,000 par value. So the amount of bonds that are being converted is $25,000. So that's the amount that needs to come off of our books for the bonds payable. Let's see, I think I put that right there. Yeah. The second piece of this then is the common stock. Now, the common stock credit, again, just to be clear here, in this case, the common stock has a par value. So we need to pay attention to that. There are 25 bonds that are converted. Each bond can be converted to 20 shares of common stock. So that's this first two steps. And then the amount that we assign to the common stock account is the par value of $1 per share for a total of $500. So we credit common stock $500. And then the final piece is just a plug. Any amount above par gets assigned to our additional paid-in capital common stock account, $24,500. Again, hopefully the conversion isn't too bad. It's meant to be fairly straightforward. Any questions on that? If there had been a discount or a premium, you would have had to figure out what the remaining balance in that discount or premium is, and you have to take that off the books as well. Okay. We're almost halfway. Almost halfway. So we're actually doing really well on time, much better on time than I thought we would, in all honesty. Although I will admit some of these later problems are actually a little harder. All right, 49er Company issues 10 shares of restricted stock to each of its 8 executives on January 1st, 2021. Each share has a market value of $12 per share. The shares cliff vest in 4 years. Yeah, somebody mentions that they overcomplicate these questions, and that, honestly, that is a challenge, is distilling the problem down to really the most important piece of the information to get to the calculation. I will say the other thing too, just as a point, I think Anna Grace and Gretchen as well, and everybody else obviously, is with each of these problems, when you read it, is to figure out which problem I'm dealing with. So if you see restricted stock, okay, I'm in a restricted stock territory, right? If I see about bond, I hear this conversion, okay, I'm bond conversion. If I see stock options, okay, I'm in a stock option problem. So, part of it is identifying the kind of problem that you're dealing with. Now, the nice thing is, because it's open book, open note, if you struggle, sort of with some of the details, you're going to have time to look up a few details. You're not going to have time to look up every detail. But that is a guide that the lecture guide can help you a little bit here and there. I wouldn't rely on it the whole time though, because I think if you do that, you're going to run out of time. All right, so we have 10 shares of restricted stock to each of its 8 executives on January 1st, 2021. Each share has a market value of $12 per share on this date. The shares cliff vest in 4 years, and 2 executives leave the company in 2021. 3 more leave in 2022, and we need to provide the compensation expense adjusting entry on December 31st, 2021. So a lot of things going on here. First of all, I give you information as far as when the restricted shares were actually issued in the first place. I also give you information on how long it takes to vest and information on when the executives leave. But what I've asked is for the compensation expense adjusting entry. So I'm not looking for the initial entry. I'm not looking for the entries when the executives leave. I'm looking for the compensation expense at the end of 2022. That's all we're trying to do here. And so first we have to imagine, and in our minds, we have to know what does that journal entry look like? And hopefully if you don't already know, you'll be able to review and get to the point where you understand that whenever you have an adjusting entry for restricted stock, it's going to be a debit to compensation expense, and it's going to be a credit to unearned compensation. Because if you remember, when the shares were initially issued, we debit unearned compensation and we credit common stock and potentially APIC common stock. And then from there on out, we take that unearned compensation and we're basically converting it to compensation expense. We're taking the unearned compensation balance down and we're throwing it into compensation expense. And we just do that over the vestment period. And so we just have to figure out, okay, given where we are and given what has happened, how much unearned compensation do I need to unwind as of this December 31, 2022 date for just that year? Remember, we would have recorded it at the end of 2021. And so it's not both years together. It's just for 2022, given who's left, what do we need to record? And so let's figure that out. So the first step then is to figure out, well, how many executives are left? Well, there are 8. And we were told 2 leave in 2021 and 3 more leave in 2022. So there's only 3 executives left. Each of those 3 executives have 10 shares. And we know that the value assigned to those shares is the market value of the issuance date, which is $12 per share. And since it's a 4-year vestment period, we only record 1/4 of that total each year. And so the entry amount would be $90. Again, so when we're unwinding, we debit compensation expense and we credit the unearned compensation account. And we just then, if no one else leaves, that would be the same entry amount for the following year and the year after that. So any questions on this journal entry?
Yes, can you please repeat on the 1/4? What happened?
Yes, absolutely. So the shares cliff vest in 4 years. And so what that says is then each year we recognize or we record 1/4 of the total. So the compensation expense would be 1/4 in 2021, 1/4 in 2022, 1/4 in 2023, and 1/4 in 2024, knowing that we only record it for employees who are still here. So the only thing that kind of differs if employees start leaving, then that would change the entry amount, but only because the number of executives changes. And so in the first year, that said 2 executives left. So the first year it would have been 6. And then the second year, because 3 more leave, it's down to 3. And then in the third year, it would stay 3 unless somebody else left. Then it would go down to, whatever it might be.
All right, thank you.
Uh-huh. Any other questions? Okay.
Quick question, sorry.
Yeah.
So with that last question, it's just asking about 2022 for this, and it's that's the only thing it's asking about with the 3 executives that are left.
Exactly.
Okay, just making sure.
Yep, it's only 2022, and on the test itself, I'm always very specific. Provide the journal entry information for this date. I don't want there to be confusion, so I always give you the date that I'm wanting the entry for.
Okay, thanks.
All right. Any more questions before I jump to the next one? Good questions, everybody. All right. On January 1st, 2020, 49 Company issues 250 shares of restricted stock to its CEO. Each share has a market value of $30 per share, and there is no par value. The shares cliff vest after 5 years. We need to provide the journal entry for January 1st, 2020, which is the date that they are issued. This is hopefully a fairly straightforward one. So the entry amount calculation, again, it's just one CEO. So that CEO is given 250 shares. And with restricted stock, you use the market value on the date the shares are issued. And in this case, that market value is $30 per share. So the total entry amount is $7,500. And as I had mentioned before, the debit is to that unearned compensation account, and the credit is to our common stock account. Now, in this case, there's no par value, so the entire amount gets assigned to the common stock account. If there had been like $1 par value, then the common stock would have been 250, and the remaining amount would have been an APIC common stock, which would have been like 7,250. I think the one in the lecture guide has a par value. So with this one, I think I chose to not have a par value. But again, so we've created this unearned compensation account. That common stock account is credited because we actually physically issue those shares. Now, those shares sit in a trust until they vest. So in other words, the executive doesn't have access to those shares, but they have been issued. And so that's why we need to credit the common stock account. And then over time, we're just recognizing the compensation expense related to those shares. And so, after 1 year, we would recognize, because they cliff vest in 5 years, after 1 year, we would recognize 1/5. In the next year, the next fifth, another fifth, another fifth. Now, if the executive leaves, like we already did, we'd have to unwind everything. We'd have to then, debit the unearned compensation expense again, and we'd have to be debiting the common stock. So the whole process after that would be unwinding it. But right now we're focused on that initial issuance, and so that initial issuance, we debit unearned compensation and we credit our common stock. Okay, and then if the executive starts to leave, all right, now we have some things to deal with. All right. And so lo and behold, on the very next problem, now we've got an issue. All right. So on December 31st, 2021, 49er Company had issued 250 shares of restricted stocks to its CEO. Each share had a fair value of $100, and there was originally a 5-year vestment period. And they were issued originally on January 1st, 2021. There's no par value or stated value. Now the CEO leaves the company on June 1st, 2022, and we need to provide the journal entry for when the CEO leaves. So again, remember, the original issuance is a debit to unearned compensation and a credit to common stock. That common stock, those shares sit in a trust, and they sit in a trust until they become vested. Now, if the executive leaves, then those shares are taken out of the trust and they are returned to the company as unissued shares. So they don't go into treasury or anything like that. They come back to the company as unissued shares. All right. And so now we've got to figure out, okay, given that this executive left, we've got to unwind everything and kind of get back to before the CEO was there. We basically have to undo the effects of these restricted shares. And so the first part of that is the common stock account. So when we originally issued these shares, they were assigned a value of $100 per share times 250 shares, which is $25,000. And so we know that we need to take that common stock off of our books. And the reason is, again, those shares were sitting in that trust. When the executive leaves, the shares are returned to the company as unissued shares. So we basically have to take that common stock amount off of our books. That original amount of $25,000 needs to come off of our books. Now, the second piece of this is the part that most students struggle with. And I explained it in the lecture guide, but I'm going to explain it again here. I want to take a little more time on this one because I do want you to think through it. Whenever the original issuance took place, the entire value of this $25,000 would have sat in the unearned compensation account. So on January 1st, 2020, the unearned compensation account balance would have been $25,000. Then at the end of 2020, 1/5 of it would have come out of unearned compensation and been recorded as compensation expense. And then at the end of 2021, that same thing would have happened again. Another 1/5 would have come out of unearned compensation and would have been recorded as compensation expense. So then when we come to June 1st, 2022, we have to think, what is the state of the unearned compensation and compensation expense accounts relative to this CEO? And hopefully it's you kind of see that, well, 3/5 of this $25,000 is still in unearned compensation, because we would have, if the CEO had stayed, we would have recorded another 1/5 in 2022 at the end of 2022, and another amount at the end of 2023, and the final amount at the end of 2024. So 3/5 of the 25,000 is still sitting in unearned compensation. 2/5 has been recorded as compensation expense. And so when the executive leaves, we need to keep those proportions in mind, because we need to take those amounts off. And so when we talk about the the compensation expense amount, 2/5 has been recorded as compensation expense. And then with the unearned compensation, 3/5 is still sitting in our unearned compensation account, 2/5 and 3/5. And so then our journal entries reflects that 2/5, 3/5 proportion. Now, if this hadn't happened for another year, let's say it was June 1st, 2023, then the compensation expense would have been 3/5 and the unearned compensation would have been 2/5. If it had happened in June of 2024, then the compensation expense would have been 4/5 and the unearned compensation would have been 1/5. Again, just you have to think about where we are in the life of the vestment period, and that tells you how much needs to come out of each account. Again, in this case, because it's June 1st, 2022, 3/5 of the total amount is still in our unearned compensation account. 2/5 had been recognized as compensation expense, and that tells us the amounts that we need to credit each of those accounts for. That's a long explanation, but I just wanted to make sure I took my time and try to explain it as clearly as I could. But I'm sure there may be questions on how I got those numbers. So either everyone's tired or I
So I
explained it
have
really
one
well.
question. So I understand how you got the numbers, but I was just curious. So for the compensation expense, wouldn't we have already made a journal entry for that at like the year end, or?
So what would have happened? So let's kind of march through time. That's a great question. So compensation expense. So at the end of 2020, we would have debited compensation expense and we would have credited unearned compensation for $5,000. That's 1/5 of 25,000. We would have immediately closed compensation expense to income summary, and then income summary gets closed to retained earnings, right? So compensation expense is now gone. So the account balance is zeroed out. Now the unearned compensation, the balance in that account would have been 20,000 at the end of 2020. Now we come to the end of 2021. Again, we debit compensation expense 5,000 and unearned compensation another 5,000, again 1/5. So now the new
Okay,
balance in
I
unearned
got it. Thank you.
compensation is down to 15,000. The compensation account expense account gets closed to income summary, and so again that's balanced out to 0. And so then when we come to 6/1/2022, the executive leaves. There's no compensation expense journal entry in 2022 up to this date. They just haven't recorded anything because they don't do it till the end of the year. And so they've recorded 5,000 in 2020 and another 5,000 in 2021. So now we're making the adjustment in 2022 to reflect the fact that really those 2 years of expenses didn't really happen because the CEO left. So they kind of worked for free because they left and gave up their shares, at least for this portion of their compensation. And so the idea is that over the now from 2020 all the way to 2022, if you summarize the compensation expense over all 3 of those years, it's 0. And then if you summarize the balance in the unearned compensation account balance is 0. And the common stock account balance is 0 for this transaction. Of course, we know there's other common stock, entries, but the whole point of this journal entry is so that looking back, everything is zeroed out.
Gotcha. Okay, so we're crediting compensation expense to take it off the books. Okay, thank you.
But I want to be very clear. The compensation expense account balance on this date prior to this entry was 0 because it had been closed. So in other words, you're going to get this weird sort of positive compensation expense, kind of a weird thing. But the idea is that over the 3-year period, it all is now makes sense.
Okay, thank you.
Good question. Any other questions? All right. Now I think these are the last 2, or we got 3 more. Okay. So this is earnings per share. Now I will say for many, many students, earnings per share is difficult. Students struggle getting earnings per share. There are enough points on earnings per share where if you don't understand how to do it, you're probably going to struggle a little bit on this test. Now, it's not to say that it's half the test or anything, but it's enough points where if you blow it off, it's going to sting. So I want to make sure that we got some extra practice on this so that you can kind of see. This first question is just calculating, weighted average common shares outstanding. It's critical to being able to do basic earnings per share. And so I just wanted to walk you through another example. So, they had 115,000 common shares outstanding on January 1st, 2021. There's a stock split, and then there's issuing new shares. And so now we've got to go through, there's a repurchase in there as well. And so we kind of have to go through and figure this out. Now, I will say also this. On the test, I'm not going to have 4 different things going on. All right. So the test is simpler, but I wanted to kind of demonstrate each of the different items so that you can kind of get a feel for it. So the first step is to kind of chart out the different event dates. And so the first event is July 1st, 2021. And so, the first row really covers the first 6 months of the year. The next event is October 1st. And so the next row goes until September 30th. And then the next event after that happens on November 1st. And so this next row is only 1 line. And then finally, we have 2 months to kind of close out our year. And so the first thing whenever you're doing this is to set up your rows to coincide with the different events throughout the year. The second step then is to get the number of physical shares outstanding for each of those rows. And we know that we start with 115,000 shares. And then what happens? It says there's a 5-to-1 stock split. And so we go from 115,000 shares to 575,000 shares, which is just 5 times 115,000. So now the number of physical shares outstanding is 575,000 shares. Now there's a repurchase of 19,275. So now the physical number of shares outstanding drops to 555,725 shares. And then finally, we issue another 30,600 shares. So the physical number of shares jumps up to 586,325 shares. So the second step then, after you get the dates laid out, is to just calculate the number of physical shares outstanding. And then I'm not going to spend a lot of time talking about this adjustment because I did talk a lot about it in the lecture guide. And so it's on YouTube and you can look that up and try to follow it closely. But basically, this is trying to make all the rows comparable to the last row. So in other words, the adjustment on the last row is always 100%. And so the only thing we want to do is if there's ever a stock split or a stock dividend, we need to make an adjustment to that row. And so we know that this row is still after the stock split. So it's still no adjustment necessary. Excuse me, this row is also after the stock split. So there's no adjustment necessary. The first row is prior to the stock split. And so that's why there is an adjustment for that row. It's a 5-to-1 stock split, so there's a 500% adjustment. Now, again, I understand that, why there and not there. I get that that could be a very common question. it is very difficult to explain it. And honestly, I feel like I explained it really well in the lecture guide. So if you didn't get it the first time, I prefer that you rewatch that. And then if you still struggle, maybe you send me an email or something like that. But just I hope I explain it. And again, the whole idea is whenever there's a stock split, you need to make sure that any row prior to that split gets adjusted so that it's directly comparable to the last row in the table. And so that's why the only adjustment is to that first row. The next piece is hopefully fairly straightforward, and that's just the weight over the 12 months. And so, how much does each one sort of capture? Now, on this one, what I did is realistically 115,000 times 500% is 575,000. And so rather than having like 6/12 and 3/12, I just combined them both into one row here and called it 9/12. If you did 6/12 and 3/12, you'd get the same answer. And then the next step is to multiply through. So again, we take 575 times 100% times 9/12, 555, 725 times 1/12, 586, 325 times 2/12, and that's where we get each of these numbers. And then we add them up for a total weighted average shares of 575,281. And that would be the denominator in our basic earnings per share calculation. Again, knowing how to do a simple version of this table is important. Any questions? So if there was a stock dividend, that would be more like the lecture guide. So if there's a split and a dividend, it becomes multiplicative. And the lecture guide really walks you through that. Let's say that this first one, and this first event, instead of being a 5-to-1 stock split, was a 10% stock dividend. Then instead of 115 going to 575, it'd go 115 and whatever 110% of that is. 11,000, so it'd be 126,500. All right, and then this adjustment would be 110%. And so the whole problem would change, of course, but stock dividend is similar to a stock split, except for obviously the way that we calculate the adjustment and the way that we calculate the new number of shares outstanding would be different because, of course, the situation would be a little bit different. Any other questions? Okay. So in 2021, 49er Company reports net income of $356,000 and 328,500 weighted average common shares for its basic earnings per share calculation. The company has no preferred stock and had a 3-to-1 stock split on July 1st. Its average stock price was $35 per share during the year. At the end of 2021, 49er has 12,500 outstanding employee stock options, each with a $57.50 per share exercise price. That price has not been split adjusted. There are no other potentially dilutive securities. We need to calculate our diluted earnings per share. All right, so tough problem. And so this is where you really got to start putting things together. First step with any one of these problems, if it's not given to you, is to calculate. Of course, this is stock options. The first step is to calculate the effect of the stock option and to figure out if it's dilutive or anti-dilutive. And so in this case, the exercise price is $57.50, but that was not split adjusted. And so to figure out whether it's dilutive or anti-dilutive, I need to get the adjusted exercise price. So I take the $57.50 per share and to divide it by the split. In this case, there was a 3-to-1 stock split. And that gives me an adjusted exercise price of $19.17. You compare that to the average price of $35 per share. And since the exercise price is less than the market price, this is considered an in-the-money stock option. An in-the-money stock option is by definition dilutive. And so since it's dilutive, it means that we need to include the stock options in the calculation of our diluted earnings per share. So in other words, we have to deal with this. Now, if it had been anti-dilutive, our earnings per share would have just been our basic earnings per share. It would have been much easier. But since it is dilutive, we have a little more complication here. So then the next step is to figure out the number of shares that were issued. Now, again, there are 12,500 stock options. That's not split adjusted. And so the split adjusted number of shares issued is that 12,500 times 3 for a total of 37,500 shares. The next step then is to figure out, okay, given the adjusted stock price, or sorry, exercise price, and the adjusted number of shares issued, now we can calculate the amount of cash that the company will receive when these employees exercise those options. So the company would receive $718,875. Now, again, you may recall from the lecture guide that we assume that any proceeds will be used to repurchase shares. And so this is calculating the number of shares that will be repurchased. We take the total proceeds, divide it by the average share price of $35. We truncate. And so the number of shares that were would have been repurchased under this these stock options would have been would be 20,539 shares. So we issue 37,500 shares. We repurchase 20,539 shares, which tells us that the net shares issued would be 16,961 shares. So the stock options would basically result in an additional 16,961 shares. So given the new number of shares issued, we're going to have a new earnings per share amount. The numerator is 356,000, which is the net income. Denominator originally was 328,500, but with this dilutive stock options, the new denominator must include the new net shares issued. So we add those two up. And so our new earnings per share, our diluted earnings per share, would be $1.03 per share. Again, by definition, if the stock options are in the money, they are dilutive. If they are out of the money, they are anti-dilutive, and they would need to be ignored for the purposes of the EPS calculation. Any questions on how to handle stock options and diluted earnings per share?
When you say ignored, you mean use the $35 figure?
No. So if it was if it's anti-dilutive, then it would, the earnings per share, the diluted earnings per share would be
Or
the
is just
same
the net
as,
income? Yeah, okay,
yeah, just be the same as the basic.
got it.
Yeah. Any other questions? All right. I think this is the last one. Okay. Last problem. All right. In 2021, 49er Company reports net income of $447,000 and 512,300 weighted average common shares outstanding for its basic earnings per share calculation. The company has no preferred stock and no outstanding employee stock options. 49er's tax rate is 35%. I'm going to just give myself a little space here. At the end of 2021, 49er has 650 outstanding convertible bonds. Each bond has a face value of $1,000, a 5% bond rate, and were issued at par. Each bond can be converted into 75 shares of common stock. Calculate 49er Company's reported diluted earnings per share rounded to the nearest penny. Okay, so just like stock options, now we're dealing with a convertible bond and trying to figure out, will this affect our earnings per share? Will this dilute our earnings per share? So the first step, whenever we're dealing with a conversion, the first step is to calculate our basic earnings per share. So let me contrast that. So with stock options, the basic earnings per share doesn't matter. Doesn't matter. Because the stock options, if they're in the money, are dilutive, and it would not matter what the earnings per share is. If they're out of the money, they're anti-dilutive, and it doesn't matter what the earnings per share is. But the conversion, it absolutely matters what the basic earnings per share is. So you need to get that number. And so in this case, the basic earnings per share is 87.25 cents per share. So we calculate that first. The next step then, once you have your basic earnings per share, is to figure out, well, what is the bond earnings per share effect? And if you remember from the lecture guide, if the effect is less than basic earnings per share, then it's dilutive and we need to include it. If it is more than basic earnings per share, then it's anti-dilutive and we would need to ignore it. So now we're going to figure out that effect to figure out, is it dilutive or is it anti-dilutive? So we have the change in the numerator over the change in the denominator. All right, so the change in the numerator. If these bonds were converted, then there would be no interest expense related to those bonds. And so basically what we have here is the 650 bonds, the par value for each bond, and the bond rate. Since they're issued at par, the bond rate and the bond yield are exactly the same. And by the way, on the test, it's going to be the same way. All right, so that gives us the total pre-tax interest expense related to these bonds. Of course, we know that earnings per share is an after-tax number. And so the 1 minus the tax rate gives us the after-tax effect on the numerator. It gives us the after-tax effect. And so the after-tax effect on the numerator is $21,125. So if they didn't have this interest expense, net income would be $21,125 more than $447,000. So that is the numerator effect. Now let's talk about the denominator effect. Each bond can be converted into 75 shares of common stock. There's no splits or anything like that, so it's fairly straightforward. So it tells us that the change in the denominator is 48,750. Is there a time when the change, so somebody asked me, is there a time where the change is negative? If it's negative, no. I mean, I can't think of a situation where it would be negative. Whether it's a preferred stock or a bond, getting rid of that item is going to increase the numerator no matter what. I cannot think of a situation where it would make the numerator smaller. And by the way, if the numerator is smaller and the denominator is getting bigger, it's dilutive. Like, so that becomes really easy. But again, I cannot think of a situation where that would be the case. So again, we have the change in the numerator, 21,125, the change in the denominator of an increase of 48,750 shares. So the bond EPS effect is 43.33 cents per share. So notice that the 43.33 is less than 87.25, meaning these are dilutive. So what that says, if you remember the lecture guide, is that when I combine these two items, when I have the basic earnings per share and then I include the bond EPS effect, it's going to land, the new earnings per share absolutely will be less than 87.25 cents. And it will absolutely be more than 43.33 cents. It'll be somewhere in between. Now, given the size for 21,000 and 48,000 compared to the basic EPS, it's going to be closer to the 87 cents than to the 43 cents. But it is going to be in between. In other words, this is dilutive because if I include this bond conversion, the new earnings per share is going to be less than our basic earnings per share. And as long as it's less than, then it is considered dilutive and it should be included in our diluted earnings per share calculation. So then the final step is to include that. So the new diluted earnings per share, we have the change in the numerator, and we have the change in the denominator. So then our new diluted earnings per share is 83 cents per share. Okay. So this kind of problem is a little more difficult. So, you just kind of have to have that step by step. Now, I will say on this test, I'm not going to have, like in the lecture guide, I sort of had like 3 things all going on at the same time. On this test, it's going to be one at a time. You're going to have a stock option problem, then you're going to have a bond conversion problem, and you're going to have a preferred stock conversion problem, but you're not going to have all 3 combined into one long problem. So any questions on how to handle convertible bonds? Again, calculate basic EPS, calculate the bond EPS effect, figure out if it's dilutive. If it is, include it. If it's not, you ignore it. All three. Oh, stock options, bond conversion, preferred stock conversion. And the preferred stock conversion is handled pretty much the same as a bond conversion, except for with the preferred stock conversion, you do not have an after-tax adjustment because the preferred stock comes after taxes anyway. So you don't have this 1 minus 0.35 adjustment. Only with bonds do you include that. And that's important, by the way, because I do see that mistake often with students. Any other questions? Okay, so the test is on Tuesday. You know, this what I'm going to do with this recording is it's going to go on the cloud. I'm also going to put it up on my YouTube channel because I know sometimes the cloud recordings aren't great. I'm guessing I'll choose either this one or the 10 o'clock one. I don't put both of them on YouTube. Both of them will be on the cloud within Canvas. But I know a lot of times if you're studying from like your iPad or something like that, the Zoom cloud recordings aren't great. They aren't real easy to see. And so that's why I put it up on YouTube as well. So someone asks, so you don't use the tax rate with preferred stock. That is true. You do not use the tax rate when you're dealing with preferred stock because it is already an after-tax amount. And again, with this upcoming test, you know, some of you, for whatever reason, didn't print out your completed lecture guides and have them with you, including the IFRS sheets. I just think that it's well worth having that in front of you because there are some questions where it's right in the notes, and if you're just not recalling it for whatever reason, you can answer that. Now, the other thing that I would, and everybody, you know, you take the test the way that makes sense to you. But I would suggest, you know, don't spend too much time looking up each problem because you may run out of time. So, you know, if you're spending 5 minutes trying to locate where this thing is in the notes, you're going to run out of time. So part of your preparation for this test obviously is getting to, you know, internalize as much of these concepts and technical details as you can. But I think it's also familiarizing yourself with the notes themselves so that if it happens to come upon a problem that you don't recall exactly how to do, you can quickly get to the notes and quickly understand where to look to help yourself. So, you know, I write this test knowing that you have the notes, but I don't write the test in a way where I expect you to look up everything. So there are some questions that I would expect that if you've studied, you don't have to look up anything. It's a very straightforward answer. Okay. All right. Well, I am shocked that we finished a little bit early. I must have been talking fast. But thank you so much for your time. If you have any questions, please feel free to email me. Otherwise, enjoy the sun finally here and enjoy your weekend as well. All right. Do well, everybody. Thanks so much.